Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today's our webinar's title is Inflation and the Potential Energy Crisis. So, hello, everybody. My name is Shen Chu. I'm the moderator for this session. Now, I'm sure you all have felt inflation one way or another. Now, things are getting more and more expensive. We have seen food prices go up, energy prices go up. If you pump RON 95, you probably don't see it because it's subsidized by the government. But if you pump RON 97, then you probably see that, wow, it has increased by leaps and bounds, right? Are you all still doing okay in this inflationary environment? All right, so today we are going to study inflation and also what are the potential energy crises. Okay, so as usual, disclaimer, whatever we share on this webinar is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that should be mentioned here. So if you decide to make any investment decisions, you are 100% responsible for all your investment risks. Okay, I see Albert says suffering from the inflation. Okay, gone are the days where we can still eat, economic rice for 5 ringgit. Now everything is so expensive. All right, so yes, let me introduce our speaker today, and he is none other than Mr. PC Wong. So Mr. PC Wong is a full-time investor, author, and trainer. He has more than 20 years of investment experience on Bursa Malaysia and also 12 years of investment experience in foreign markets such as Hong Kong Stock Exchange, SGX, Nasdaq, New York Stock Exchange, Australian Stock Exchange, and the London Stock Exchange. So he literally has his portfolio in every developed market. Okay, so he is a best-selling author of Invest in Foreign Shares and Invest in REITs, and also the book Global Economic Collapse. His area of expertise includes financial analysis in broad sectors in the resource industry and REITs. He has 8 years of experience teaching retail investors in local stocks as well as global stocks. Academy-wise, he graduated from National University of Singapore in 1989. So without further ado, let me hand over the session to you, PC. Hello, PC.
Hi. So okay, very good evening, everyone, and thank you, Shane. So the topic we'll talk about today is what causes inflation, why we could potentially see an energy crisis. Now, when we talk about energy crisis, it's not so much as what we are seeing locally, but more on a global basis. I'm sure most of you all have followed the news about the Russian-Ukraine war and how the EU is sanctioning Russia and leading to a lot of problems with the supply of energy in the EU. And because Russia is a major exporter of natural gas, as well as oil and coal, being sanctioned or being restricted in its exports, the problem have actually extended far and wide, not only in EU, but also in the United States and globally as well. And that energy crisis is made worse because OPEC has not been able to commit additional supply of natural gas to Europe. And also, they are unable to increase production of oil to help meet the gap, from the removal of Russia as a major exporter. So all these are being felt globally, and in Malaysia, we are thankful at least that the 95 is still subsidized. But because energy plays an important role, it's now spread over across other sectors as well. But we'll talk more about that. Then we'll have a look at the ESG economy. Now, the ESG economy has been overhyped, where I'm concerned, because one of the key things is that the world is not well prepared for for a dramatic shift from fossil fuel into ESG economy. And the ESG economy comes with it a lot of problems, which I will share later on. And then we'll see what role it plays in this energy crisis. And then we'll look at what will happen in such an energy crisis. And lastly, we'll end with what kind of what sectors would actually benefit from this energy crisis. Now, definition of inflation. A lot of us would think that, hey, you know, inflation is due to increase in the price of goods and services. And price is an indicator of inflation. Now, for those of you who think that inflation has everything to do with price, then you are wrong. Inflation is actually the expansion of money supply. Okay, so by expanding their purchases of assets, especially bonds, major central banks of the world, the Fed, ECB, and BOJ, are effectively expanding the supply of money. And the BOJ, especially BOJ is actually the Bank of Japan, has even participated in buying ETFs that are of stocks that are listed in the Nikkei index in Japan. So it's not only a buyer of bonds, but it's also a buyer of stocks indirectly through the ETFs. So often when they start to expand the money supply, price is actually a laggard which comes after the expansion of money supply. And inflation is a reflection of the reduction in the purchasing power of a currency. Now, some of you might say that, hey, you know, the US dollar is a very strong currency. If you have looked at the currency, the Forex market, the best performing currency this year is actually the ruble, which has appreciated from a low of about 150 rubles to the US dollar. Right now is about 58 rubles to the US dollar. So a lot of people think that the US dollar is a very strong currency. But if we want to track back the US dollar, ever since the US dollar removed itself from the go back US dollar in 1971, it has actually depreciated more than 90% in terms of its purchasing power. Why? Because it has a lot to do with increase in national debt. So here we have the Federal Reserve, and we can see the amount of money printing that the Federal Reserve has done over the last 10 years. Okay, so you can see that the Fed have increased its total assets by $6 trillion or 211% over the last 10 years. So all these are actually an indication that the more money is put into the market, the higher the expansion of money supply, then, you know, it's just the law of supply and demand. When you have more supply, invariably, the value would actually decrease. And that value is not shown in terms of the relation of the US dollar to other currencies, but in relation to the purchasing power of the currency. And when the purchasing power of the currency drops, that is when you have inflation. So we look at the ECB. Now the ECB itself in 10 years time has actually increased its total assets by 5.8 trillion euros. And that is just about the same amount of the Fed, okay, because translated into US dollar, that's more than $6 trillion. So their total assets have actually increased 196%. So let's look at the BOJ. Now in 10 years, the BOJ has increased its total assets by 596 trillion yen, and that's 427.5%. So the yen actually have weakened dramatically against the US dollar. And on top of that, the euro as well. And because the weakness of these two major currencies, it has actually helped the US dollar to push higher. But if let's say you think that the US dollar is a very strong currency, in terms of commodities, the US dollar have actually depreciated about more than 20% against a broad-based commodities, much more, okay, in terms of oil. Because if we look at it, at one time in March 2020, oil actually fell to negative $11 per barrel during one of the during the COVID-19 pandemic. So then oil actually started to go up, and for a very long period, it was in the 40s to 50s. So because of the extreme money printing over the last few years, since March 2020, oil actually have appreciated against the US dollar as well. So that's why the currency itself has actually depreciated against real hard assets, which are the commodities. So not only the other banks, not only the Fed, ECB, or the BOJ, but the PBOC, or the People's Bank of China, has also increased its total assets by 28.7 trillion, or 256%. Now, the China Central Bank have not bought any bonds like QE and such, but what they did, they actually went into a lot of repo purchases, okay? So because of that, their balance sheet or their total assets have also expanded. So when you have 4 major banks participating in expanding the money supply, what do we have? Okay, so over the 10 years, all of them have actually collectively printed $16.79 trillion, okay, where the Fed, ECB, and BOJ are concerned. Okay, here we focus on these 3 because they were the ones that actually did a lot of QE, quantity easing, which is buying bonds, funding the government, because the government issue bonds. So in order to keep interest rate low, they buy the government bonds so that they inject money or liquidity into the market. So if you look at it, although they have printed quite a lot of money since 10 years ago, but inflation did not happen until 2020 and all the way through 2021 and 2022. So what happened then? Now, if we look at it, when they started their QE, okay, what happened was there was a sudden surge in demand because of the people were anticipating that the QE 1 to 3 after the global financial crisis, people were actually expecting that there will be inflation. So that was why commodity prices were actually very high during the early part of the global financial crisis, which is around 2009, because during that time, China injected about, if I can recall, about 8 trillion renminbi or yuan into their market. And because of that 8 trillion renminbi injection, there were huge demand for commodities. So what happened was, after the surge in 2009, when the commodities went up very, very high, a lot of the producers were trying to meet that demand and they overproduced. So when you overproduce, okay, again, the law of supply and demand, while demand has not really taken up quite dramatically, but the supply side has actually gone up quite dramatically. And therefore, you see that the price of the commodities, soon after the injection by the Chinese central bank, the prices actually start to come down. And for a long period of time, we see that there was a period where there was oversupply and the price of commodities have actually come down. So when they oversupply the market, what happened was that the economy was actually not performing as well, okay, because the period leading into 2015 and 2016, we saw the Chinese stock market crash, okay? And during this period of low interest rate, okay, especially among the ECB, BOJ, and the Federal Reserve, what happened was that during this period here, there were intense financialization by the corporation. What I mean by that is that the corporate, instead of getting the cheap credit to expand production capacity or improving the mining infrastructure, they spend most of it in buying back their shares. And because of that, we see the US stock market continue to record new highs, okay, almost very frequently. It's like almost every quarter, because the money, the easy credit, is not used to increase production capacity and improve the mining infrastructure. So because of that, we have what we call malinvestment, which means investment that are actually used not for productive purposes, or underinvestment in commodities production. So when COVID-19 struck, okay, they started printing money even more aggressively, okay? And you can see that a lot of the central banks from the ECB as well as the Fed keep on mentioning that, you know, there's no inflation. Inflation is just transitory. By 2022, we will see prices coming down, and that has proven to be wrong. And during this period, as I mentioned, price is always a laggard. It takes some time before price is finally felt in the market, because all these years of underinvestment, okay, and when COVID-19 struck, a lot of people were selling off their assets. They are not willing to, they are very fearful of what happens. So when demand starts to pick up, suddenly there is not enough production capacity to meet demand, okay? And what soon followed thereafter is that inflation has become very, very persistent. So that's why inflation may not come until some years later, okay? Because all through the period here, despite QE 1 to 3 and low interest rate, a lot of the money went into the financialization of assets, namely buying back shares, okay, acquisition and such, that the money is not put back into the real economy. That is investment in plant and equipment, investment in labor, investment in infrastructure. No, the money did not go into those productive part of the economy, but went into the financialization of assets. So that is why the stock market went up, but inflation is still not felt, because inflation have to be felt when there is a sudden surge of demand and the production capacity failed to meet that surge in demand. So that is why inflation, we see it running very, very high. So what are the things that can actually worsen it? Okay, let's talk about the Russian-Ukraine war. Now, the banning of Russian imports, especially energy, has resulted in higher energy prices, especially oil, gas, and coal. Now, oil, for example, WTI has risen by 63.1% to $103 per barrel in 1 year. Now, this was up to 4th of May, but I think today is already past $110 per barrel, okay? Natural gas has risen 167.7% to $7.80 per MBTUs, okay, in 1 year. I think right now it's about $8. It has also risen since then. Coal has risen 260% to $280 per ton in 1 year. So all these have very great influence in inflation, because energy is the center of all economic activities, okay? For example, we sometimes think that energy is something which we use, for example, fossil fuel, okay, something that we use in terms of transportation from point A to point B. It's used in the factories for manufacturing, but even more importantly, okay, energy is in all types of economic activities. Every type of economic activities actually will burn energy. So not only do we have a shortage of the energy, especially where it concerns the taking Russia off the export of energy dramatically. Russia is also a major producer of wheat, fertilizer, neon gas, titanium, copper, nickel, gold, silver, palladium, platinum, and uranium. And banning the import of these products will add to the existing inflationary pressure. So for example, right now, I think the United Nations is warning that by the end of this year, certain third world countries will experience famine because Russia and Ukraine are actually two of the world's largest exporter of wheat. Okay, and Russia and Belarus is also being sanctioned by the EU. Both of them are the world's largest exporter of fertilizer. Now, fertilizer price actually have gone up quite a lot, and because of that, farmers are actually reducing the input of fertilizer in their farms, and that would actually result in lower crop production. So that is why food is actually going up. And neon gas, for example, a lot of people say that the shortage of semiconductor will actually be over by this year. I can tell you that once Russia takes Odessa, since it has already taken Mariupol, both of these two cities actually export 50% of neon gas. And neon gas is a very important element for the functioning of the EUVs. Now, EUVs are lithography machines that are used in the production of semiconductor, especially the higher capacity type, okay, let's say from 7 nanometer and below. Titanium, Russia is the world's largest producer of titanium oxide sheets, which are being used for the construction of aircraft. And copper is used everywhere, okay. Nickel is battery material, okay. Gold, silver, palladium, and platinum are actually precious metals, but palladium and platinum are actually important in the automobile industry. And platinum is also used in the production of hydrogen fuel cells. And of course, uranium. Now, uranium is also another, is also widely used for the production of energy. So all this actually impacts the world. We not only have an energy shortage of energy, but we have a shortage of commodities as well. And it's quite ridiculous when they want to ban Russia, because Russia is the world's largest country with resources, and they are valued at $70 trillion. So how can you remove such a huge country from the global economy? Definitely there'll be shortage everywhere, and that is why inflation is being made worse. So another thing that happened is that what's happening in China. Now, China is the world's largest factory, okay? And with its manufacturing base and major port being locked down due to its zero COVID tolerance, they invariably lead to the breakdown in the supply chains, pushing the price of logistics and goods higher. Now, here you can hear this is a picture of the Shanghai port in the month of April. And there are actually 1,000 ships queuing to be loaded and unloaded. So imagine you have that 1,000 ships waiting for their queue, waiting in queue, okay? So they are not able to actually unload, load, and then go to the next destination. So the number of days that they are waiting okay, would put those ships into being unproductive. And that is why, even though to a great extent the global economy has reopened, you can see that the freight rates out of Shanghai has remained high, okay? And if we want to look at pre-COVID time, the container for 40-foot is actually around 2,000 plus per 40-foot container. And right now it still remain high, between 6,000, above 8,000 to about $13,000 per 40-foot container. So it's still about 5 to 6 times higher than the pre-COVID era. And because of the congestion in this in Shanghai port, the turnaround for the ships from one destination to another has become much longer, and that would actually lead to higher logistic costs. So that is why shipping costs will actually remain high, and because shipping is an essential cost of for retailers, okay, logistic is an important cost for retailers. And if let's say the logistic costs have gone up by 5 or 6 times, then retailers can actually be losing a lot of money. Because if you are looking at goods, that supermarket goods, okay, some of them are just enjoying 5 to 10% margin. But if let's say logistics have gone up so much, what they do, they just need to keep on increasing their price, okay? But suddenly they not only have an increase in price in logistics, but increase in price of the energy, okay? Because if you are in a shopping mall, you have to pay higher rates for the electricity, okay? So all these costs are being added, okay? And if some of you have read or follow some of the biggest companies, okay, we talk about, let's say, you know, even big companies with Amazon, they rely on very small percentage, and that shipping cost itself is tipping their profit margin from a positive into negative. So that's how huge the impact of logistics in the supply chain. And what are the other causes for this kind of inflation? Now, of course, that's the underinvestment in facilities and infrastructure and others. Now, during the period of low inflation and low interest rates, companies would rather buy back shares than to invest in plant, equipment, and labor to improve productivity. Now, productivity is the center of the economy, because if productivity increases, the cost of manufacturing goods actually becomes lower. And because the price of goods become lower, there will be more consumption. And when there's higher consumption, company would continue to invest in expansion of the production capacity, and higher consumption would lead to higher GDP growth. And because company invest in plant and equipment, fixed investment is also an expansion of the GDP. So productivity is the center of the economy. And because they rather buy back shares and not expand their productivity, therefore, you do not see the true potential of the money that is printed being put into good use. The resources industry, facing a decade-long bear market, saw little investment interest, leading to low exploration and discovery of new resources and lack of funding to build new mining infrastructure. Okay, so for example, let's talk about oil. When the oil price is low, okay, there's very, very little investment done, because they find that, you know, there's no point in exploration of oil because we do not know how long oil can remain at a very low price. Then when oil started to pick up, okay, there is not ready production capacity, okay, or new discovery being made to actually exploit on the higher price of oil to increase production. So that caused a certain shortfall, okay, because when you actually, in terms of oil exploration, it takes a few years from exploration to discovery to putting into production. But because there is no investment interest, there is low exploration, therefore it leads to low production when demand finally picks up. So this leads to a sudden surge in prices when supply fails to meet the frantic demand after COVID-19 lockdowns. Then the other thing, tight labor market also contributed to the high inflation due to the increase in wages needed to draw talents. Now, when inflation goes up, companies would actually have to increase the wages to draw talents. Otherwise, no one wants to work, because when the salary does not meet the inflation, then what's the point when your salary is not enough after taking into consideration of inflation to continue with your livelihood? And then with the central banks widely expected to tighten their monetary policies, interest rates are expected to rise. Okay, we have seen all the major central banks of the world, stating that they are going to increase interest rate. Okay, predominantly, in the Bank of England, Canada, even Bank of Nigeria has recently increased interest rates. So all these are why the need to increase interest rates is actually to combat inflation. Because if, let's say, interest rate is not raised when inflation is very high, then that particular country's currency would actually weaken. And when it weakens, people would use that currency and convert it to another that is showing appreciation. So that's why the currency value will continue to drop. And that is why it's very important that certain benchmark interest rates are maintained so that we do not see an outflow of capital. But tightening the monetary policies will only exacerbate the availability of funding to expand production capacity. Because who wants to expand production capacity when you need to fund at higher interest rate? And in an inflationary environment, the cost of equipment would have also increased. So what this becomes is that it has turned into a vicious cycle, okay, leading to even higher inflation, okay. And when inflation becomes chronic, what we see will be a result of hoarding and removing the availability of goods from the market. Now, Malaysia have not seen a very high inflationary environment for quite some decades. And as a young child in the 1970s, whenever I switch on RTM, there is always campaign by the government during the 1970s. For example, tanamlah sayur-sayuran dan buah-buahan sendiri, okay, encouraging people to grow their own food. Then there's also a warning against, I often see complot sorok, okay, which means hoarding, illegal hoarding of goods. So there were a lot of campaigns during the 1970s. And for those who actually went through the 1970s, at that time, the FD rate is actually about 11 to 12%. And the borrowing rate from the banks is actually 15 to 17%. That was how inflation was during the 1970s, okay? And with famine widely expected by the United Nations, this is a very worrying trend, okay? And that is why you see that even countries like India today reported that they are going to cut down their sugar export. Indonesia banned the export of palm oil for about a month. And I think today Malaysia say that they would actually stop exporting chicken, if I'm not wrong, okay? Because inflation is causing a lot of countries to finally become very nationalistic in their economic policy. And when you have a very nationalistic economy policy, it will lead to a kind of pushing globalization into the history, because suddenly every country wants to preserve their food, because food is very important for the population. Okay, so that's why the global supply chain will continue to see breakdown. Okay, and certain goods, okay, if we are making our goods locally, then hopefully Malaysia, if they consume locally, then the locally produced products, then perhaps, you know, the inflation in locally made products will not be there, but inflation of imported products will be there, because other countries that export it to us, when there is shortage of materials, shortage of raw ingredients, they would actually have to increase the price. Okay, so that is why one of the key thing, okay, to overcome this is to actually support the local industries. Okay, so how inflation can turn into stagflation. What happened in the 1970s in Malaysia is actually stagflation. Okay, it was a worldwide phenomenon. So what happened is that before stagflation happens, okay, there must be inflation, and that results in central banks across the world are tightening their monetary policies amid a major slowdown, like currently what we are seeing. Okay, although we have not really felt it, okay, like Malaysia first Q1 was pretty good, okay, but the major economy, okay, like the US, during their first quarter, their GDP growth was actually negative 1.4%. When you have a first quarter of negative GDP, you are just a hair's breadth of seeing a recession if the second quarter GDP falls into negative territory. So even China, because of their COVID lockdown, the world's second largest economy, is seeing a slowdown. Their April economic indicators were a disaster. Retail sales was down 11%. Okay, so I think the other thing that was down is actually industrial production. So retail sales are an important gauge of the economy because it is private consumption and it is measured as a component in the GDP. So if consumption is down, then definitely China's Q2 GDP is going to take a hit. Now, when you have the two major economies, okay, potentially facing a major slowdown, then it will affect other countries as well, big or small. So when you have inflation and you have a slowdown, that is when we have a stagflation. Okay. Now, why I think stagflation will get worse? Now, this is because the present inflation is not due to an economy heating up, but by the expansion of money supply, war, and underinvestment to increase productivity. So if let's say the economy heating up, what we see will be very, very huge demand of inflation. And it is also driven because the money changing hands, we call it the velocity of money, is very high. Okay, so but right now, okay, we do not have, the world does not have the an economy that is heating up and therefore a need to address the inflation. But it is done by the expansion of money supply, war, and underinvestment to increase productivity. So these are negative factors. So the stagflation will be reminiscent of the 1971 to 1980 era. And the only difference is that we are sitting on a global debt time bomb of more than 300 trillion US dollar. Total global debt at the end of last year was actually more than 300 trillion US dollars. And for those who try to gauge what is trillion, is actually you have 300 followed by 12 zeros. Okay. When there's so much debt, then it becomes a challenge for central banks whether they can raise interest rate high enough to actually service their debt. Because at 300 trillion, assuming inflation now, let's say on the average, Europe is 7.5%. Okay, we take the highest one. Okay, Europe is 7.5%. US is 8%. Let's say we treat it as 7%. Okay, easier to calculate. If the central banks, in order to fight inflation, by hiking interest rate, it must be above 7%. So let's say they hike 8%. That means that the annual debt service interest is actually 24 trillion. Total global economy is about 70 to 72 trillion. That means that a third, okay, of the GDP has to be used to service the debt. Do you think it can happen? It can't. Okay, imagine if you are earning 100,000 a year, okay, 30,000 of your gross salary is needed to service the debt. How can one survive? And that is why the central banks cannot raise interest rate to beat inflation. And because they cannot raise interest rate to beat inflation, inflation will continue to go up. So as inflation goes up, a lot of manufacturers will cut production because the price of raw ingredients are going up. Okay, energy price keep on going up. So people have to cut production and lay off. So what you have is even a worse stagflation, because recession can become a deep recession. So that is why a lot of the major banks of the world, in order to save themselves during the last global financial crisis, have gone on a money printing spree. And that has made a lot of emerging economies suffer as a result, because we need, okay, to trade with major economic power in order to survive. So if, let's say, their economy collapse, it will impact us as well. Okay, so that is the dilemma that the whole global financial system is currently facing. Due to too much money printing, inflation is overshooting expectation, and they can't raise interest rate to beat inflation convincingly because of too much debt in the world. Okay, and it's such a shame because a lot of emerging economies, okay, we are still keeping our debt to a manageable level. Okay, let's say Malaysia government debt to GDP is less than 100%. Okay, I think it's about 60 to 70% in total. But can you imagine US is 130%? Okay, so that's the biggest debtor in the world. So because of the major central banks of the world, they have gone on a money printing spree just to protect their economy from collapsing. Okay, it has actually made it into a disaster for other smaller economies as well. And that will become a major challenge that we will face. So, and this chart shows you that, okay, this is, stagflation is for real. Because if you look at it, the World Bank is actually forecasting that global GDP forecast, okay, will be 3.2%. But inflation is over here, okay? So when GDP growth is slower than inflation, that is when we have stagflation, okay? So a lot of people are expecting that, hey, GDP can still be positive as we enter into 2023. Yes, there could be. Hopefully, some countries, some of the Asia countries would be able to withstand that. And to a certain extent, I think it might not hurt us that badly because we are a commodity producing country. And if let's say the commodities price continue to go up, then I think our stronger commodity presence would actually help us to offset, inflation that comes with imported goods. So I think one of the key way to actually fight that kind of global inflation is perhaps we learn to support more of our local producers, okay, so that the import of goods is reduced so that we can keep a healthy trade balance. Now, what is happening between now and the 1971 to 1980 stagflation? Now, let's look at the 1971 to 1980 stagflation first. Now, Lyndon B. Johnson's The Great Society policy funded by debt. Then the US got embroiled in the Vietnam War. So both events happened in the 1960s, giving rise to excessive US debt and fueling inflation. So much so, now before 1971, US dollar is backed by gold, which means that countries that trade with the US dollar can actually use the US dollar and demand from the US delivery of physical gold. But because the US debt has actually exploded, Nixon had no choice but to pull the US dollar out of the gold standard. And for those of you who have read about this, the joke is that Nixon said, on that fateful day, that the US dollar will pull out of the gold standard on a temporary basis. Now, that temporary basis have expanded to 51 years. Okay, so that's why the once the US government see how easy it is to print US dollar to finance their warmongering, okay, to finance their economy. So it's so simple, okay, you just print. But if let's say if Malaysia would to just print, okay, to finance whatever our government wants for the population, for example, infrastructure development, all those, they would put a rating on us and saying that, give us a very poor rating so that the ringgit will actually drop in value. But they can do it, okay? So in 1973, what happened was because Nixon pulled the US dollar out of the gold standard, in 1973, energy crisis arose from OPEC's oil embargo due to their loss of confidence in the US dollar. But in 1976, Henry Kissinger went to the Middle East and got the Middle East, Saudi Arabia, okay, promising Saudi Arabia protection if they were to sell oil using the US dollar. So ever since then, global trade has been US dollar, and that has worked to the US benefit because US can print all the US dollar that it wants, and because global trade have to be done in US dollar, that inflation is being exported to other countries outside of the US dollar. So, and those countries that accept US dollar, rather than just holding it without any interest and all those, they actually put it back into US Treasury. So then the US continue to print dollars, selling US Treasury, and foreign reserve banks globally have to keep US treasuries, and therefore US government have managed to keep inflation low but export the inflation elsewhere. So that was how the petrodollar influenced. And now moving forward to 2021 and 2022. So Lyndon B. Johnson, we have the Great Society, and what we have for over the past decade, ever since then, was the global financial crisis bailout. Then we have the Make America Great Again by Donald Trump, printing more trillions. Then we have a repo crisis in 2019. Then we have COVID-19. So all these are actually printing a lot of money, much more than what Lyndon B. Johnson did. Okay. Then right now we have the Russian-Ukraine war, and we have excessive global debt from 2008 to 2022, and money printing by central banks resulting in more than $300 trillion in debt. You can see that although history seldom repeats itself, as they say, but it often rhymes. Okay, so what is happening is that pretty soon we are going to have a new monetary system that will be implemented by Russia, leading the EAEU, Eurasian Economic Union, and China. Now that will be a new monetary system that is in the making. Okay, and 2021 we have the energy crisis due to ESG guidelines, and 2022 sanctions against Russia. So you can see that the similarity, okay, between the two. So the impact of ESG. Now, a lot of people say that it's global warming. Yes, I do understand. We need to ensure that global warming will not impact the planet's health too negatively, okay, because that would result in a very damaging environment. But the thing is that the developed economies, you can see that a lot of things that are happening in the world is actually well outside the influence of many emerging markets economies. It's all being decided by the developed economies. Why? Because they have the power in the IMF, the World Bank, all the major institutions, they are residing in those, and it's dictating how the world should behave, okay, because they have the clout. So what happened was that they went on a crusade to promote the ESG economy. But it is not done by first evaluating, ensuring that, hey, you know, before we go to, let's say, plan B, how can we look at reducing current consumption of fossil fuel gradually before we move to plan B? No, you know, what we have is that the IMF, the Federal Reserve, the ECB went on to support investment in renewable energy, but avoid investment in fossil fuel. So like in the US, President Biden actually cut off the Keystone project, and they also limited the licenses for the exploration of fossil fuel. Okay, then in the European economy, they rely on solar power as well as hydrogen, as well as wind power at the expense of fossil fuel, because they say it's bad for the environment. So when you have all these institutions that support, you know, a removal of investment in fossil fuel, definitely, you know, there won't be enough resources being discovered to power the world, when taking into consideration that the renewable energy has still yet to mature. So harvesting renewable energy and building an electrified infrastructure require raw materials which are mined and located in some of the most remote places on Earth. Mining raw materials require fossil fuel as a source of cheap energy. So a lot of people like to say, you know, hey, wind power is really good, okay? It's renewable, it is green energy. I would urge you all to Google and see what happens to the wind turbines. If you Google wind turbines graveyard, you will see that all the wind turbines are not recycled, okay? And once they have reached a certain lifespan, they are buried in the ground. That's renewable energy for you, okay? So that is why when, you know, for lithium, for example, you know, they talk about battery minerals, lithium. Lithium is the most environmental damage mineral to be mined, and it requires a lot of water to be processed. So Suddenly, all these, are not on the syllabus. Okay, what is good is that batteries are the future. So that's why, what I'm stating here is actually to provide a balanced view that you cannot have immediately, before you learn to walk properly, you immediately want to run. And that is what is happening, because the figureheads, with all the big institutions in the world, they are dictating what should and should not be done, okay, when it comes to fossil fuel. And shipping and overland logistics require fossil fuel to move goods. Can you imagine, is there a charger somewhere in the Pacific Ocean? No, ships still require fossil fuel to move goods. And then renewable energy such as hydro, wind, and solar are not reliable 24/7, 365. The low rainfall, frost, and insufficient sunlight throughout 2021 have affected Europe's power generation, resulting in heavy reliance on coal and gas to provide warmth during the winter. Now, this has resulted in higher price of coal, gas, crude oil, and uranium, as all four are interrelated in the energy cycle. So sometimes ESG may look good on paper, but I think we need a gradual transition so that, while we transit to renewable energy, we should also explore ways in how do we reduce the environmental damage when it comes to mining of minerals, battery minerals and such, rather than just rush headlong into it, and showing full disregard for the damage to the environment. So it's like you succeed A, but you created problem in B, C, and D, okay? So that is why, all this create by itself a crisis. So if we look at it, major oil companies are divesting a huge portion of their portfolio to meet ESG guidelines. So not only is it affecting the investment into fossil fuel, but we are also seeing major oil companies are divesting, their portfolio to meet ESG guidelines. So Shell, for example, has set plans to divest itself of 12 refineries, of which 9 have been completed. So even Shell is actually divesting, okay? Shell also plans to reduce its carbon footprint. You can see here, okay? It is going to reduce its gas share of hydrocarbon production by 2030 by 55%, okay? So they want to have reduction in traditional fuel production by 2030 by 55 million tons per annum, okay? They want to reduce oil production, okay, by 1.1 to 2% per annum, eliminate upstream routine flaring by 2030. So even the big oil companies, they have been obliged to follow this because the ESG guideline has been instituted in the investors' guidelines as well, which means if, let's say, the company does not meet its ESG standard, then the funds would not be able to buy or hold that particular investment in that company. So that's why this is being instituted across major oil companies. Yeah. So Shell is actively investing in EV charging stations, hydrogen power, wind power, carbon capture and storage. And BP is another oil major moving into renewables as well. So BP has come up with its own plans for all this. So what does this goes to show is that when they pull out the investment from fossil fuel, they are putting it into renewable, and suddenly there's a gap there because fossil fuel is still one of the easiest to get access to, okay, rather than to let's say when you go into renewable, you need to build out the solar panel farm, the solar energy farm. You need to expand the wind turbines, and also it's additional investment. So what they have existingly, they need to gradually phase out. So this actually caused an imbalance in the supply of fossil fuel in the world. Now, global renewable energy capacity is currently at 290 gigawatts, or 6% of total current capacity. So that's how small they are. But in order to force compliance or force conversion into renewable, okay, there is still a lack of 94%. Okay, it is estimated that there is a need of funding by $4 trillion in order to transit to a fully decarbonized economy. Funding which the world will be short of due to rising rate environment. Okay, and you know the global debt is already 300 trillion. So that means it encourages more countries to take up debt in order to finance their ESG compliance. So this is like forcing it onto a lot of companies and a lot of countries which may not be able to have that kind of funding to transit to full ESG economy. Okay, so that goes to show there's a gap, okay, of 94%. Probably, I think fossil fuel would perhaps make up out of the 94%, perhaps fossil fuel or oil, gas, and coal would actually take up maybe 70%. Another 24% would be nuclear. So even that, you know, more than half would still require fossil fuel. So fossil fuel is also primarily used in transportation and power generation. It is also used to manufacture important polymers which are transformed into goods which we consume in our daily life. So, you know, rather than just see that fossil fuel is only something that is for transportation, okay, is for energy, but fossil fuel is still required, you know, in the manufacturing of polymers, and even some of it can be converted, okay, into some, you know, some of them could be converted into fertilizers as well, okay. So when, you know, try not to look at fossil fuel as something just as, you know, for transportation. They are also required in the manufacturing of other things. So if we take out fossil fuel, it will only cause the, you know, the price of polymers to be much more expensive. So underinvestment in fossil fuel exploration will result in lesser reserves being discovered. Okay. Need for fossil fuel will remain for as long as energy is consumed for mining, processing, manufacturing, shipping, and traveling. So this goes to show that energy is the key source of everything that has to do with the economy. And you cannot rely on just one sector, which is now only contributing 6% of current capacity, whereas more than 50% is still in fossil fuel. And because of that, we are, you know, that energy crisis is being expanded into a greater crisis affecting the global economy, including a lot of the emerging economies. Okay, how many emerging economies, especially those that are not commodity based, okay, they have to look at securing that energy which actually has expanded, you know, in terms of pricing. You know, just like Sri Lanka actually went into a debt default because food price increased, okay, and energy costs increased. So the people were actually raiding the warehouses, supermarket, and all those because they do not have that commodity. You know, thankfully, we are a net exporter in terms of fossil fuel. Okay, we also have palm oil, which can be, you know, made into biofuel. Okay, in that sense, I think Malaysia is quite blessed. Okay, and you know, because in other countries that do not have the key energy source, you know, they are actually facing dire situation. So what happens then? When supply fails to keep up with demand, it will result in price increases. Because fossil fuel is widely used in multiple sectors, inflation will likewise be widespread across all sectors. Inflation just made the cost of raw materials needed for the ESG economy more expensive. So let's look at, when we just now we say the cost of fossil fuel. Okay, let's look at minerals, battery minerals. In 1 year, price of lithium has gained 411% per ton. Price of cobalt has gained 85% per ton. Price of nickel has gained 52.1% per ton. Now, these are important materials for EVs and batteries for storage. So that is why, when you have a sudden push into one area, it has pushed up the price of battery minerals. And because you have an underinvestment in another, you are pushing the price of fossil fuel. So all at once, you have, renewable energy also facing inflation, and fossil fuel also facing inflation. So a forced departure from fossil fuel when the world has not readily prepared itself for will spell disaster for the world's energy needs. So let's look at the impact from the Russian-Ukraine war. Now, shipping of oil and gas is a major issue due to the lack of fleet size to cater for global demand and refusal by insurance companies to provide insurance for Russian-registered ships. Now, this is happening because of the sanction. Now, sometimes when you ship goods, you do not just say, I will load this product and then I will ship it elsewhere. No, that's a thing called insurance. And insurance are managed by financial institutions. But because of the removal of Russia from SWIFT, insurance companies are actually in a bit of a dilemma, because if I insured the Russian ship, and while transit to a destination, suddenly you change the sanction into another one. And then what happened to the goods on transit? Because I can't unload it at that destination because of a certain shift in the sanction, okay? And I cannot ship it back. So that's why insurers actually say, might as well not handle Russian ships. So that is why, even the shipping of oil and gas is being affected in that manner. So as the effect of the sanctions on Russia are biting, Saudi Arabia and UAE warned, okay, earlier that their spare energy capacity is decreasing in all energy sectors. Because of the now Saudi Arabia, they have their own Aramco, which they can actually roll out their own production. But not forgetting, a lot of major oil majors are actually investing in Saudi Arabia as well. But because of the ESG guidelines, they are unable to expand their capacity. So what can a single Aramco do? Even Aramco also have to meet ESG guidelines because they want institution funds from the West to invest in that company. So because of that, there's right now no spare energy capacity. US is now facing a diesel shortage, pushing its price to a new record high. Price of gasoline has also reached a new record high. So can you see that how the EU and US is shooting themselves in the feet or in the foot because of the sanctions against Russia? Okay, wanted to destroy Russian economy, but the Russian ruble keeps on increasing in value against the euro and against the US dollar. And right now they are facing an energy crisis. And what is even more disturbing is that the US Congress is drafting an antitrust bill against OPEC called the NOPEC deal, which OPEC warned could propel the price of oil to $300 per barrel. Now, this antitrust bill gives the US extended jurisdiction, okay, to charge OPEC countries or their governments for manipulating the price of oil. So that's how serious it is. Now, if let's say that hits, then all, the gloves are off between the US and OPEC. And this will be, it will be a full-blown, oil crisis like what happened in 1973, where the OPEC just refused to supply to the US. Excuse me, I have a sip. So, and another news that I just got it today is that the EU is considering having an total embargo on Russian oil. But because there were many countries that were against this, I have not put it on this slide, but I just got news that Germany said they could reach an agreement to have a full embargo against Russian oil in a matter of days. Now, right now, Russia can still export oil, okay? But if let's say it's a full embargo, we no need to wait for this, okay, $300 per barrel. And if let's say that embargo hits, Goldman Sachs actually previously have warned it can easily drive oil to about 185 to 200. If let's say Russia oil is, total ban, okay? So if let's say we have the EU oil embargo and then we have the OPEC deal, this is going to be a nightmare for the global economy. So when that kind of price exists, the global economy will go into hyperinflation, okay? So that means certain goods will actually keep on skyrocketing. And it is very sad because a lot of all these things that is happening is well beyond, our control, because our economy is not a major player in the world stage. We cannot dictate terms, we can only watch. It's just like the Malay proverb, gajah sama gajah berlawan, pelanduk mati di tengah-tengah. Okay, so we are that pelanduk. So that is how grave the situation is. But thankfully, again, Malaysia is a net exporter. We have some good companies, okay? And that's why Malaysian oil companies will be the major benefactors. So in that sense, okay, perhaps if let's say oil price continue to move up, our economy will benefit, okay? And that will actually help to prevent, the situation from turning bad versus countries which actually have a lack of commodities. So let's look at the movement in the price of oil, okay? So why I think Malaysia would be in a beneficial position, okay? Now, stronger price of oil, we can really tell it's going to move up, okay? Whether it's OPEC or the oil embargo, but just because banks, they have printed so much money, okay, inflation will continue to rise up, okay? And one of the things is that never trust the Fed, okay? This is a principle which I always abide. So you can see that how the oil price in terms of ringgit have moved, okay? Let's say from just in 1 year time, okay, it was at 260, right now is at 417 up to April, okay? So over the 12 months, price of oil in ringgit has gained 74.6%. And right now, we have a variable exchange rate of about 4.4 to about 4.39. It's fluctuating, a few cents here and there, okay? So if let's say oil price increase, it will be to our benefit in that sense, okay? So what will be the sectors within the oil industry that will do well? Now, it is important that we need to discern pure play oil companies could stand to benefit more, especially the producers. Now, explorers will still be saddled with getting the investment it needs for exploration, but those producers and explorers, they will do reasonably well, if the price of oil goes up. Now, due to consistently lack of investment in exploration, those providing offshore services for exploration companies will be unlikely to benefit from a much higher oil price. Because as I mentioned, higher interest rate would make it very difficult to get funding for exploration. And because a lot of big oil, the major oil companies, they are moving away from expanding their carbon footprint, and therefore they would have less money for exploration of fossil fuel, especially, in offshore oil. Now, offshore oil is very costly. If, it can go from a price of, let's say 60 million per well to about 250 million per well for deep water well. Okay, so where is that money going to come from? Because even the oil majors, they are moving away from this kind of investment. So therefore, those providing offshore services, I think they will not be in a position to benefit from it. But existing producers, okay, who are also explorers, okay, because then they, pure play, because a lot of Malaysian companies, they just do what they are good at, okay, so they have the money from the high oil price, they can actually expand, okay, within the same block of tenements, okay, they can actually expand their exploration in the vicinity. So companies will provide oil and gas shipping services will also benefit due to the shortage of oil and gas ships in the market to meet rising demand, especially ships to transport LNG to Europe. Now, one of the things that the Europeans did was that, okay, we are going to stop buying cheaper Russian oil, Russian gas, okay, but we are more favorable for more expensive US LNG, okay, but the thing is, right now, there's a shortage supply of LNG ships to send to send LNG from US to Europe. And that is why LNG shipping, the cost of LNG shipping has actually gone up. So downstream companies could also benefit owing to favorable pricing environment, but needs to manage input costs effectively. But I think that on the retail side, I think they would not get the kind of uplift that the pure oil producers would have, okay, in that sense. So it could also benefit, could also encourage a shift into biofuel companies as an alternative source for energy. Now, I would like to add, aside from this, okay, because inflation is really there, those other sectors that are non-fossil fuel related, okay, especially in food, okay, in the palm oil, could do quite well, especially Ukraine is one of the world's major supplier of sunflower oil, and right now that is already out of the market. So when there's a shortage of vegetable oil, it would inflate the price of vegetable oil across the board. And also, perhaps, I think palm oil could also benefit through an extension from the biofuel side, okay? And also, as an investment hedge, you could also look into the Sharia-compliant gold ETF, okay, as a hedge against inflation, because during the 1970s, gold actually went up 26 times from 1971 to 1980 due to the stagflation. So if you want as a hedge against inflation, okay, and stagflation, you can also perhaps consider the Sharia compliant gold ETF. So anyway, this is just my opinion. I'm not a financial advisor, okay, and this is not a financial advice. Please do your own diligence. So that's all I have. Thank you very much.
Yeah, thank you so much, PC. What a mind-blowing session. So if you feel that it is equally mind-blowing for you, you may type one. Let me know if you feel the same. I think this session is very macro. I think we learned a lot more about geopolitics, resource industry, as well as the central bank's monetary policies. Okay, so if you have any questions for PC, you may write in the Q&A box, then we will address it. Yeah, I think looks like many of you here agree with me, eh? Right, you may write in the Q&A box. Don't write in the chat box. We have less than 5 minutes to do the Q&A. So now the first question is asked by Ya Yun. If the US remove the sanction on Iran or Venezuela, would the price of fuel go down?
Okay, to answer on Iran. Now, US just announced they will participate with Israel to launch a mock attack on Iran's nuclear facility. So do you think US would want to negotiate a deal with Iran? I doubt so. If let's say if they really want to, they would not have announced their participation with Israel. Now on Venezuela, US actually talk to Maduro, hey, you know, although we destroy your economy, although we sent, you know, tens of thousands of your population to death because of our sanction on medicine and medical, you know, but it's okay. We are now giving you, we are now going to buy from you 200,000 barrels of oil per day. How do you think Maduro would take it? Obviously, they will still look after the interests of their citizens, but I think they will, exert a price to be paid by the US government. So even they buy from Venezuela, it's just a replacement of the Russian oil. Now, some people would say, why US oil? Isn't US oil a major producer? Yes, but US oil is actually light oil, and they need to blend with heavy oil from Russia, which they previously imported, and right now they need to import from Venezuela, because if they cannot blend it with heavy oil, the US cannot refine their own oil. Okay.
Okay. Now, the next question is, would the US face a recession this year? I think this got a lot of questions. What are the possible solutions to turn around this dire situation? Besides the increase of interest rate, would the reduction of money supply deteriorate the economy and the equity market?
Okay, the Fed is going to talk that they can do wonders, but they actually cannot do. So I often would term it, some Chinese would say, if you do, will die. If you don't do, you will surely die. Okay, so it is a position where either way, okay, they cannot reduce inflation without if they hike interest rate, okay, up to 10%, it would put the US government into insolvency, because US tax collection is 4.5 trillion. At 10% interest rate at 30 trillion, it will be 3 trillion per year to service interest. That left 1.5 trillion from the net collection. Now the Pentagon would have already taken 800 billion. So that left 700 billion to finance their Social Security, Medicaid. Do you know that the US Social Security funding is actually zero? Whenever they need to pay citizens on claims for Social Security, they need to borrow money from the market. So the Fed cannot raise interest rate. So if they do QT, it will create a liquidity crisis. So that liquidity crisis would force a lot of people to sell off corporate bonds, okay, because there's no buyer. Like the Fed used to be buying the mortgage-backed security to help the housing market. But right now, if they are doing QT, there's no more backing for the mortgage-backed security. What will happen to the US housing? Just as when prices are at record highs, we could see a global financial 2.0. So either way, however the Fed do, there's no do will die, don't do will surely die. That's what I meant. Okay.
Okay, thank you so much, PC. The next question is, what do you think about nuclear energy? Would it make a comeback? This by Maslan Yusuf.
Yes, nuclear energy would make a comeback because they actually have no choice. Okay, and for your knowledge, China is going to build 150 nuclear reactors from in a decade's time, because China already knows that there's going to be an energy crisis, there's going to be high inflation, and that is how China sees it. But China is also not depending solely on nuclear power plant. They are right now buying Russia oil and gas at a huge discount and store it in their reserves.
Okay, let's do one last question. What do you think about Malaysian currency strength? Will it continue its depreciation against US dollar and Sing dollar. But looking at how we are a net oil exporter country, will the rising oil price help to support our ringgit?
I think if let's say oil price really goes up, yeah, and commodities really goes up, that will happen in a case where the US dollar will weaken, okay? Because at some point in time, the Fed will realize they cannot raise interest rate to beat inflation. And when that cat is let out of the bag, okay, US dollar will tank, okay? And Malaysia ringgit to US dollar will actually see an appreciation of Malaysian ringgit, okay? So that is one way that if that happens, it will be to our benefit. Okay.
Okay. I think let's do one last question by William. Why the low inflationary and low interest rate environment will lead to companies more interested to do share buyback instead of investing in plant?
That is because the CEOs are all paid by stock options. So that is why you see that companies like Boeing spending billions of dollars in share buyback to enrich their executive. But when the 787 MAX happened, Boeing tank, okay, then the shareholders are left holding the bag because they borrow money on the cheap to buy back shares. And right now, when interest rates are going up, we see that they are borrowing at a higher cost to pay for debt that they borrow on a lower cost. But it doesn't matter because all the CEOs have been selling their shares over the last year, because last year saw the highest outflow of insider funds, okay, insider selling, okay. So this year, interest rates are going up, so shareholders are left to hold the bag, okay.
Okay, thank you so much, PCC, for doing this session, inflation and the potential energy crisis. I think now we are more aware what do you mean by potential energy crisis, and then we are more aware of what are the inflationary impact, and then what are the monetary policies going on right now. So let me just quickly go ahead to my screen to tell you more about our next session. Okay, so thank you so much, PC.
Thank you, Shane. And
all right, so our next webinar is titled The 1, 2, 3s of Stock Trading. So we're going to look into how do we do stock trading using the 1, 2, 3 patterns. So tradings may not need to be very complicated and complex. It can be as easy as 1, 2, 3 or ABC. Okay, so in the next session happening on this Friday, 27th of May, we'll be looking at this 1, 2, 3 of stock trading. All right. So the registration link is here. So I've given you the registration link. All right, you may go ahead and register for this session. We have invited the principal consultant of the MSTA program and CFTE program to come and conduct this session. All right. So with that, I really appreciate your sharing, PC, for doing this a very complicated yet very insightful session with us for us to understand inflation and energy better in this session. So hope that, I really hope that the world can come to a peaceful resolution and no war, and everything can revert back to the normal, like how COVID-19 can revert to a, pre-pandemic session where our life are a bit more normalized lah. All right. So thank you so much, everyone, for tuning into this session. Hope you all gain enormous value from this session. So we'll see you next in our webinars happening on Friday. All right. Thank you, everybody.
thank you. Good night.